In January 2021, a stock went from under $20 to nearly $500 a share in less than 3 weeks. Over 3 million people piled in. The internet called it the greatest David versus Goliath moment in financial history. But here's what nobody told you: the short squeeze everyone talks about, the one that supposedly broke Wall Street, was responsible for only a tiny fraction of the move. The real engine behind GameStop has a name most people have never heard: a gamma squeeze. It was far more obscure, far more powerful, and is still almost completely misunderstood. By the end of this video, you'll know exactly what it was. January 2021. The financial world was glued to a single stock, GameStop. A struggling brick-and-mortar video game store that most of Wall Street had left for dead. But suddenly its stock price defied all logic. It exploded from under $20 to a peak of nearly $500. The popular tale was simple and compelling: a band of retail investors, coordinating on the Reddit forum Wall Street Bets, discovered that hedge funds were massively shorting the stock and, in an act of collective defiance, they bought up shares. This was a populist uprising against the financial elite, a victory for the common person. But what if the short squeeze wasn't the main event? What if the villain, the trading app Robinhood, wasn't acting on orders from a shadowy cabal of billionaires? The U.S. Securities and Exchange Commission, the SEC, conducted a thorough investigation. And the SEC, the actual government agency that spent months investigating every trade, reached a conclusion that the mainstream media almost completely ignored. Here's what they actually found. Let's start with the story everyone knows: the short squeeze. The story became a Hollywood movie. It was a feel-good fable of David versus Goliath, where an army of Redditors bankrupted greedy hedge funds. And to be clear, GameStop was one of the most heavily shorted stocks on the market. At one point, short interest exceeded 140% of the shares available for trading. This sounds impossible, but it happens because the same shares can be lent out, sold short, and then lent out again, creating more short positions than actual shares in existence. This created a tinderbox. A rapid price increase forces short sellers to buy back shares to cut their losses. That buying pressure drives the price even higher, creating a feedback loop. And a short squeeze did happen. The SEC report confirms it. Hedge funds like Melvin Capital famously lost billions and needed an emergency cash injection from other hedge funds just to survive. Citron Research, another prominent short seller, tapped out at a 100% loss. These were real, painful losses for firms that bet against GameStop. But here is where the official story crumbles. According to the SEC's own report, the buying pressure from short sellers covering their positions was only a small fraction of overall buy volume. Let me repeat that: a small fraction. The data just doesn't support the idea that this was the main factor that drove the stock price to nearly $500. In fact, the SEC concluded that it was sustained buying from individual investors that kept the price up for weeks. This was a buying frenzy, a speculative mania that took on a life of its own. But the short squeeze wasn't the real story. The thing that actually sent the stock into orbit has a name most people have never heard, and once you understand it, you'll never look at the market the same way. So if the short squeeze wasn't the main engine, what was? The answer is buried in the complex world of options trading, and a phenomenon that many analysts argue was the real explosive element: gamma squeeze. A lot of retail investors weren't just buying shares. They were buying call options. A call option is a bet that a stock will go up. For every person buying a call option, there's someone on the other side selling it, usually a professional market maker. These market makers don't want to gamble. Their job is to make a small, safe profit. So, to hedge their risk, they buy a certain number of the actual shares. Think of it like a snowball rolling downhill. As the stock rose, market makers had to buy more shares to stay hedged. That buying pushed the price higher, which forced them to buy even more. A snowball turning into an avalanche, and it fed on itself. As GameStop's stock price began to rise, thousands of call options that were previously worthless suddenly became close to being profitable. This triggered the gamma squeeze. It was like pouring gasoline on a fire. Retail traders, whether they all understood the mechanics or not, had effectively weaponized the structure of the options market to create a feedback loop that sent the stock into orbit. While the SEC report was cautious about attributing causality, many argue this relentless forced buying had a far greater impact on the stock's meteoric rise than the short squeeze alone. If this is the first time you've heard of a gamma squeeze, you're not alone, and subscribing means you won't miss the next time the mainstream completely gets a financial story wrong. But before any of this could fully play out, something happened on the morning of January 28th that stopped everything. And it had absolutely nothing to do with hedge funds conspiring against you. January 28, 2021. The frenzy is at its absolute peak. And then, the buy button disappears. Robinhood, the app at the center of the movement, abruptly restricted the buying of GameStop. Users could sell, but they couldn't buy. The stock price tanked, and the internet erupted in outrage. The narrative that formed instantly was one of a grand conspiracy. The story went that Citadel, a massive hedge fund that had just invested in the struggling Melvin Capital, pressured Robinhood to halt trading to save the shorts. It was the ultimate betrayal. The platform that claimed to democratize finance was rigging the game for Wall Street. But once again, when Congress and the SEC investigated, the truth they found was less cinematic and a lot more technical. The restrictions weren't the result of a smoky backroom deal. They were triggered by the very plumbing of the stock market. When you buy a stock, the trade doesn't settle instantly. It goes through a clearinghouse, in this case, the DTCC. The clearinghouse is the middleman, and to protect the system from a brokerage going broke, it requires them to post collateral for their trades. Think of it like a security deposit. For extremely volatile stocks like GameStop, the clearinghouse can raise those collateral requirements dramatically. And that's what happened. In the early morning of January 28th, Robinhood got a call from the DTCC. The bill was for $3.7 billion, and it was due immediately. Robinhood simply did not have the cash on hand. Faced with defaulting on their obligations or limiting the activity that was driving up the bill, Robinhood chose to restrict buying. This doesn't absolve them. Their risk management was clearly unprepared and their communication was a disaster. But the investigations found no evidence that they acted to protect hedge funds. Instead, it points to a liquidity crisis at the brokerage, driven by a surge in trading that stressed the foundational systems of the market. This brings us to the final myth, the idea that the GameStop saga was a clear-cut victory for the little guy. While some early investors made life-changing profits, many others did not. The story went viral when the stock was already at incredible highs. Lured in by the fear of missing out and headlines of easy money, countless people bought in near the peak, only to watch the stock crash back to earth. And here's the number that the feel-good headlines never mentioned. On February 2nd alone, the stock lost 60% of its value in a single day. Not over a week. Not over a month. One day. And the people who were told to hold the line were the ones holding the bag. The hype was fueled by more than just memes. It had a real story, thanks to activist investor Ryan Cohen. Ryan Cohen, the entrepreneur who built Chewy into $1 billion company, had bought a major stake in GameStop and was publicly pushing for an e-commerce pivot. That gave retail investors a legitimate reason to believe the turnaround story was real. And what about the hedge funds? While Melvin Capital was famously routed, eventually closing down for good in May 2022 after the hit, Wall Street as a whole did not lose. The idea that this was purely retail versus institutions is a fallacy. It was a chaotic free-for-all where institutions also battled and profited from each other. In fact, some of the biggest winners were other institutional players. Hedge funds like Invest Management, which had bought into GameStop months earlier, reportedly walked away with over $700 million in profit. They saw the momentum, jumped on the bandwagon, and profited from the ride up. GameStop wasn't a revolution. It was a perfect storm: retail enthusiasm, hidden market mechanics, and a system that nobody fully understood, including the people inside it. The lesson isn't that the little guy can beat Wall Street. The lesson is that the story you're told after the fact almost never matches what actually happened. Here's what GameStop actually taught us. In the modern market, the thing that moves a stock is almost never what the headlines say it is. The short squeeze was the story everyone told. The gamma squeeze was the story that actually happened. Learn to look for the second story. That's where the truth lives. The first story was wrong. And now you know exactly why. If you want the version of these stories the mainstream gets wrong, the real mechanics, the hidden forces, the second story, hit subscribe. We just dropped our breakdown of how $32 billion empire of Sam Bankman-Fried's FTX and Alameda collapsed overnight. Go watch it. It's right there on screen.